All right, good morning, everyone. So please open up the spreadsheet and PowerPoint from last time. We're going to be using those as references today. I'm putting together a cause of change for another company. All right, so what I want us to work on today is basically you walking me through how to put together this cause of change analysis. All right, so we're going to put this together for Walmart, and we're going to be following the outline that we went through with Amazon last class. All right, so if I want to get Walmart's financial statements, what's the first step for gathering that information? Yep, go to Edgar, sec.gov. It'll get you to the same place. All right, then we go up into the top window here, search up the company we're looking for, either by its name or its ticker. You can get the reports here, but it's a lot easier to find the Excel files if you go to the classic version. Scroll down, look for the 10K. Interactive data, and then we'll get the Excel document. All right, now we have what we need. So just so we get this in its own workbook, I'm going to copy and paste this over to a new spreadsheet. All right, so we have some information in here that we can't see. What's going on with that? Scroll in a little bit for you. Yeah, right. So all that's going on here is we physically, Excel cannot show the information that's in the cell, right? So whenever that happens, it's not an error. It just means you got to expand the window to view the contents. All right, so we expanded that window. We'll just do some very brief formatting to make this a little bit more legible. All right, so condensing those sheets. Get this all in format. All right, so now we have basically a functional income statement that we can start using now to put together our cause of change. All right. So looking back at the Amazon, right? What are the 3 steps we're going to be going through to get the cause of change analysis? Yes, it does. Yeah, exactly. All right. So the 3 steps we're going to be going through. The first 2 is basically just so we get a working format. Right. Step 1, we're going to be calculating the relevant ratios to create this now workable spreadsheet built up through references. So step 1 is just getting those ratios that we need. Right. Like we were talking about last class, there's a ton of ratios that we can use to evaluate companies. For the specific purpose of cause of change analysis, all we're trying to do is recreate the financial statement just in a way that we can change the inputs on calculating the net income. All right, so that's what the first 2 steps are all about. We're getting the ratios that are relevant for calculating this now functional spreadsheet. And we're going to be combining these 2 bits of information in the last step to get the actual cause of change analysis. Right? What changes resulted in the output in the net income? All right, so a couple things to keep in mind now as we're going between the 2 spreadsheets. I highly encourage all of you to have the Amazon spreadsheet pulled up as a reference, but keep in mind these are different companies, and different companies have slightly different ways of representing information. Right? Like I mentioned last class, sometimes companies will have negative values that you're subtracting out from the bottom line, expenses. They'll post them as negative values, or maybe they'll keep all the values as positive, like we see here, and we subtract out the expenses to arrive at the net income. So keep that in mind. Also keep in mind that there's some discretion on how exactly companies refer to different forms of revenue and expenses that the company incurs. Right? Amazon breaks apart their expenses into more detailed bits of information, but as we see when we switch over to Walmart, it basically just has cost of goods sold, selling, general, and administrative. It's a little bit simpler when you're dealing with that sort of cost structure, but it's not as informative. All right. So swapping back over to Walmart now. we're going to get our ratios. All right, we're just going to focus on the last 2 years here. All right, so we're not getting a ratio for revenue itself, right? That's not going to be informative. It's just revenue is a proportion of itself. So what we're going to be focusing on here is getting the ratios for what constitutes our net income at the bottom line. All right, so let's go through here and look at this. All right, so Walmart is posting 2 forms of revenue: net sales, so that's just going to be money that they receive for making a sale; membership and other income. All right, so that's going to be something like people paying for Sam's Club memberships. They're not necessarily tied to a direct sale that Walmart is making, but it reflects income still coming into the company. All right, so to simplify things, we're going to focus on total revenue, and we're going to use that total revenue as our metric for revenue of the company, combining net sales and membership income. Always important to keep in mind, as you're going through financial statements, things should be adding up to the bottom line that you're arriving at. Right? So it's always a good idea as you're going through this to just, every once in a while, just check that the numbers you're working on are adding up to what you're seeing in this financial statement. Right? So for example, if we are wanting to make sure that the total revenue that we're going to be relying on adds up to the $611,000, right? In this case, you could just highlight net sales and membership income. It's adding up to $611,000. I know you can't see it from back there, but if you have the spreadsheet pulled up on your computer, you'll be able to. All right, so we're going to use this total revenue as our company. This is going to be in percent of revenue. So we're going to have cost of goods sold, percent. All right, so we're going to start off with cost of goods sold. They report it as cost of sales. Same idea, right? Companies will have slightly different words, names for these different expenses, but we're functionally dealing with the same thing. All right, so we're starting off with cost of goods sold. So how are we going to calculate cost of goods sold as a percent of revenue? Yes. Exactly. So the phrase that we're looking for, though, is total revenues. But yes, yeah, definitely the right direction there. So we're going to take our cost of sales, divide it by total revenue, and it gets us our cost of goods sold as a percent of revenue. All right, copy and paste that over. Usually it looks a little bit better when you keep it in percentage format. If when you convert it over to percentage format, it drops down to no decimal place, I definitely encourage you to expand that to 2 decimal places out. Right? The reason being, it is rounding by up to 0.5 percentage point, and as we know, small percentages can result in drastic differences. So just having that little bit of extra information is going to be helpful. All right, so we have cost of goods sold as a percent of sales. Next, we're going to get selling, general, and administrative. These two are going to make up by far the largest proportion of companies' expenses. All right, so how much is our selling, general, and administrative? What percent is that going to be? How are we going to calculate it? Yep. No, this is something that we're working on in real time. So we started off just going to Edgar, downloading the financial statements through the usual process. After we opened that up, I copied and pasted the income statement to a new workbook. Yes, yeah, Walmart. Uh-huh. Okay, so a couple of things. Did you enable editing when you first downloaded the worksheet? Okay. When you copy and pasted the financial statement, did you use any sort of special paste? Okay, so check that. If you have the option to paste as numeric values, but yeah, sometimes when you're translating information between workbooks, things can get a little funky. All right, so selling general administrative as a percent of revenue, right? Not a trick question. Got the formula listed there under its definition. Mm-hmm. Exactly. Yep. Oop. Yeah. B9 divided by total revenue. This gets us our selling general administrative as a percent of revenues as well. All right, so like I mentioned, these make up the vast majority of expenses for most companies, right? Especially for retailers, you're going to see them make up a very large percentage of the revenue. All right, so we've got the largest chunk of revenues taken care of, but there's a few other things that are going on. All right, so we've arrived at our operating income. Now we're dealing with interest expenses and some other little tidbits. All right, so what we have going on here is they're reporting how much money they spent on paying debt. Right, this could be a combination of paying interest, paying down some principal, but we have our debt, we have lease expenses, then interest income. So income that the company generates holding on to some forms of debt from other companies or governments. That brings us to interest net income. All right, so if we just highlight the debt, finance leasing, and interest income, we'll see that those three sum up to this interest net expense. And so that's what we're seeing here is we basically see the total cost of debt that Walmart is incurring in each year. All right, so we're going to get cost of debt as a percent of revenue now. All right, so how are we going to calculate cost of debt as a percent of revenue? Mm-hmm. That's it. Yeah. All right. Like I mentioned about the rounding, rounding can have significant effects. Without any rounding, it looks like our cost of debt is zero. Is the company's cost of debt zero? No. All right. So again, put some decimal places, usually 2 when you're dealing with percentages. Interesting bits of information being reported can change like that. I got really excited. So when I'm looking at my own investment portfolio, usually I'm looking for really low cost ETFs, and an ETF just came out that its total average annual expense ratio rounded is 0%. Right? That's been one of the best innovations in the field of finance is the lower cost of investing over the last several decades. And now there's an ETF with its rounding, but an average annual expense ratio of 0%. Right? So there is still an expense, just when you round things, bits of information can change. And they're using that zero net annual expense as a marketing point. Right? It's not actually zero, they're rounding, but it's so low that they're capable of rounding down toward that. So, all right, we have debt. Let's keep looking at their income statement. We've gone through debt. They have some other things going on here, right? So we can just have a miscellaneous expense. All right, now let's look back at Amazon at a couple of things, right? There was only 5 items that we had to get percent of sales ratio for, and we're not done with Walmart, but it looks like we're going to have more than that 5. Right? There's some additional expenses potentially going on here. Right? So always keep in mind when you're looking at companies' financials, there might be slight differences between them. For the most part, they're going to follow the same general structure, revenues, costs, income, but there are going to be slight differences in the items that are being reported. All right, so we're going to start working on this miscellaneous expense here now. All right, get this as a percent of revenue. And now we have our pre-tax bit of information. We have our cost of goods sold, we have selling, general, administrative, debt, miscellaneous expenses, a couple more things we got to go through. All right, we're going to have to get our income tax, but we're going to take this as a percent of our taxable income. All right, so income before income taxes, taxable income. All right, so to get our tax rate, we just take how much we're paying out in taxes and divide it by our taxable income. So 2023, Walmart had a relatively very high tax rate, so likely paying off some taxes owed in previous years that accumulated over time. Now we have the tax rate. And there's one more little bit of income of info going on down here. Consolidated net income or loss attributable to non-controlling interest. All right, so this is a bit of income coming on from just holding portfolio securities that they don't have controlling interest in, but they do have some sort of stake in. Right, you add those two together, that gets you to the total bottom line for the consolidated net income. All right, so we'll just get this in as our investment, and we're taking this as a percentage of taxable income. All right, and now I think we have the information that we need to start putting together the financial statements. All right, we have revenues, we have the costs tied to those revenues, and that should bring us to the bottom line of the company. Yes? Investment? Yeah, so took this as a percent of taxable income. All right, so investment divided by taxable income. Trying to keep this information tied to the different stages of the income statement. All right, so these first expenses that the company is incurring, all pre-tax expenses. Then when we start getting to the tax rate, we're going to be focusing on taxable income after that section. Technically, you could tie the tax rate and investment income to the revenues as well. That wouldn't be wrong. But here we're explicitly seeing what the tax rate is for the company. Any other questions on step one? Yes. So of the ratios we were talking about last class, I don't think they would quite fall under any of them. These are basically just for getting a common size balance sheet, right? So what we're trying to get here is what percent of the company's revenues or taxable income are tied to these different expenses. And we're going to use this now to create an income statement that is dependent on these percentages of revenue, that are dependent on these expenses. Any other questions? All right, so step two, we'll start putting together our own income statement. All right, so we'll start with our revenue. All right, so this is starting off with just our total revenues for these 2 years. All right, so just referencing the top line item. All right, again, we simplified it a little bit by summing up all of that revenue into Walmart, but that's going to make the rest of this balance sheet, income statement, a little bit easier. All right, so always important to go back and forth while you're constructing these financial statements to make sure that the information that you are building matches up the information that they are reporting. All right, so we have our revenues. Now we're going to start netting out our costs. All right, we're going to get our cost of goods sold. All right, so using this ratio that we already calculated, how are we going to calculate cost of goods sold in the income statement and all the preceding expenses? Exactly. Yeah. Oop. We take our revenue that we just calculated, multiply it by the cost of goods sold. All right. Now we have the information that we need. And I'm going to go through, I'm going to start fixing references because we're going to be copying and pasting some of these down. All right, so we have cost of goods sold. That's going to bring us to our operating income. All right. How do we calculate operating income? Not quite, right? So what we're doing here is we're getting basically an intermittent income, right? So there's different levels of income. So we start with operating income, which is our revenue net cost of goods sold. After that, we're going to take our oh shoot, I'm one level off, actually. Yeah. All right. My mistake. Yes. So the step that we should have done first is exactly what you were about to suggest, which was yes. Mm. All right. Let's double check that our values are matching up. 127, 127, 117. All right. So looking good so far. Now we can get our operating income. Close. You're missing one other step, right? So operating income is one of the first levels of income the company is generating. So this is going to be our revenue, net operating costs of cost of goods sold and selling general administrative. All right, so it's going to be our revenue, net cost of goods sold, net selling general administrative. Yeah. Are we matching up? Yes. So far, we're matching up. All right, so we have the first level profitability. We'll just get a little border at the bottom here to note that out. So we have our operating income. All right. So a couple more things that we have to net out here. Next, we're going to take care of our debt. All right. Like you've all been pointing out, we're going to take our percent of sales, multiply it by sales, and make sure we have our cost of debt. Yep, we've got that. Oh, there is one line item that we're going to have to go back and fix that I almost forgot about. All right, so we have our debt expense. Now we're going to take our miscellaneous expense. All right, and that's looking good. Fixing our references, so when we copy and paste this, it'll still work. All right, so one thing that I missed in calculating our debt over revenue was taking any loss of paying off debt, right? So let's go ahead and add that back in. Yeah, we should still get the same ratio, yep, but it's going to change for 2022. There we go. 4. Okay, and it's adding up. All right, so this brings us to our taxable income. All right, to get our taxable income, we start from operating income, net out debt expenses, miscellaneous expenses, and we arrive at taxable income of $17,000. We should arrive at $18,696 for 2022. All right, so far, everything is looking good. All right, we have our taxable income. Two more things we have to take care of now before we arrive at the final bottom line for this company. Question? Yes. All right, so debt. We have the pure debt expense that the company is paying out for debt. The next line item of leases, so right, basically rent. Interest income from holding on to other companies or government's debts. And then you have interest net, right? So this is going to be the cost of paying your interest, net any income that you have from holding on to debt. And this is the ratio that we're calculating over here. But we're also adding in loss of an extinguishment of debt, so basically paying off principal. And so we're adding both the total net expense and the extinguishment of debt divided by total revenue. So this is going to be our total debt divided by revenue. And then the miscellaneous expense is just the other gains and losses that they have down here. Right, so we could title it other, miscellaneous, however you want to go about it. Oh, step 2, okay. All right, so step 2, same process we've been following. We take the percent of sales ratio of debt, multiply it by our sales. That gets us our total cost of debt of $1,874. Copy that over. We should arrive at $4,200. Then under miscellaneous, again, following the same steps, we take miscellaneous expenses as a percent of revenue multiplied by our current year's revenue, and that gets us our miscellaneous expense of $1,538. All right, and from there, we get our taxable income by taking our operating income, netting out our debt, our miscellaneous expenses. That brings us to our taxable income. Any other questions so far on step 2? All right, so we have our taxable income. Now we're going to take out our taxes. Our taxes now are going to be referenced to our taxable income as well as our investment income earned as well. So we take our taxable income, multiply it by 1 minus our tax rate. And that gets us, that's our income net of tax. There we go. Now we have our tax expenses. And I fixed reference to that tax rate, so when we copy this over, it'll translate. Then we'll have our miss income. That's going to be our investments multiplied by our taxable income. All right, so miscellaneous 388, 388. And finally, we're getting our net income. So that's going to be our taxable income minus our taxes. Add in miscellaneous income. All right. Make sure that we are lining up. I'll copy and paste this one more lower so we can keep it in the same row. All right. And it looks like everything's working out. So our net income in 2023 is $11,680. That's what they report in the financial statement. 2022 is $13,673. Correct. taxable income minus taxes plus miscellaneous income. Again, always keep in mind that how companies report this information can have an effect on what you're calculating. So it's always important to go back and forth between the statement you're constructing and what they're reporting to make sure that things are making sense between them, right? You may be able to follow these same exact steps for the company that you're valuing, but very likely there's going to be slight differences between the information that the company you're looking at is reporting and how you're going to compile that information to arrive at the bottom line. So always be mindful of when you're putting together your financial statements and making sure that they're matching up with the information that's already provided to you. All right, any other questions? Yes. Okay. All right, so miscellaneous income. Boop, boop. All right, so we start off from taking our investments as a percent of income before taxes. Then we take our investment as a percent of taxable income, multiply it by our taxable income. And that brings us to miscellaneous income. Any other questions? All right, on to the last step. I'm going to go back up top. All right, so we're going to start off with our baseline. Check references. I'm not sure why this broke. All right, we can update those references really quick though. $3,000 income. Oh, I didn't copy everything over anyway. All right, I'm just going to go ahead and fix the references to make this a little easier. Oh, that's why the reference broke. It would be referencing a cell out of view. That's why. Okay. Miscellaneous. Taxes. 18. All right. Everything else should be okay. Yes. All right, so now we have our baseline. Okay. And whenever we're looking at cost of change, we're going through line by line to see how each change results in the different net income. Right? And the whole reason we constructed our initial balance sheet is when you copy over the information from the financial statements, right, they're not showing you the math that's resulting in this bottom line. Right? It's basically just reporting the numbers. Right? Accountants have already worked through the steps of calculating this, but the financial statement itself is not reporting the math behind arriving at the bottom line. So we constructed this financial statement. Now we have one that is manipulatable, right? So if we change an input, let's say they just happen to have zero revenue, right? and everything adjusts, and we see the loss that they're getting. All right, but we need this reference to the adjusted net income. All right. I'm actually going to take out some of the fixed references now that I've copied it because we want all of these to reference this current percent of sales. I should have left that alone. It's not changing any of the values, it's just changing the reference. All right, rest looks as it should be. All right. So just to save a little bit of time, I'm going to go ahead and copy over our adjustments that we're going to be making. All right, cost of goods sold. I'll update this. Change to selling general administrative. Taxes, miscellaneous income, and net income. All right. So now we have the ones that are relevant. All right, so now one by one, we're going to go through and change what's going on in this income statement. So copy. Okay. Okay, there we go. All right, so now that I fixed the mess ups that I went through with the fixed cell referencing, what I should have done from the start is within each item only fixed reference to the percent of sales. Right, so that was the mistake that I made when copying this over into our cause of change analysis. I fixed everything, then started undoing those fixes and realizing that when I started copying and pasting forward, it was still referencing the revenue in step 2. All right, so easiest way to fix that error is just keep references fixed to the step 1 ratios, but allow the reference to vary to whatever the revenue is in the current year that you're in. All right, so we're going to start with changing up our revenue. Right, so first step is going to be our new revenue. Right, so as we change our revenue, what's going to happen to the bottom line? And let's look at the change. All right. And we'll look at the nominal change. So the difference between our profits just from the change of revenue and the percent change. So the growth in the income. All right. So I am going to fix reference while we copy and paste this. Format. There we go. So I am going to fix this revenue because now that revenue is not going to be changing. We're going to change each other input going down the income statement to see what the result is. All right, so when I copy and paste this over, you should see no difference. No, actually, let's fix to the initial amount. All right. All right. Now we're not changing the revenue. We're going to be changing our cost of goods sold. All right, we're going to update our cost of goods sold from the 74.9 to the 75.86. As our cost of goods sold increases as a percent of revenue, what's going to happen to our net income? In other words, our costs increase. If there's just a cost increase, what's going to happen to the bottom line? Yeah. All right, so we should expect to see that our cost is increasing, so our bottom line should decline. And that's exactly what we see. All right, significant reduction in bottom line because we had an increase in our cost of goods sold. All right, so we updated our reference there. Now we'll go our next step. Now we're interested in changing our selling, general, and administrative. So again, if our costs increase, what should we see happen to the bottom line? All right, now we see a decline. All right. Operating income is matching up with the operating income that we calculated in step 2. So far, what we're going through is correct. Next, we have a change in debt. Nope, not there. Debt. All right, operating income is just intermediary income. The change that we're looking for now is what is the change in debt. All right, so we're going to change our reference going from 2022 to 2023. And we see that it's going to have a more positive effect. Our income increases. We shouldn't fix that reference, I guess. There we go. Yeah. All right. All right, so now we have our change in debt. Our miscellaneous expenses are up next. All right, so miscellaneous goes from 0.52 to 25. That's increasing our income a little bit. And our taxable income, $17,016, matching up to our taxable income below. All right, now we have our taxes and miscellaneous income going on. All right, so almost there. All right, taxes. Our tax expense went from 25 to 33. So we see our taxable income increase to 5,700, and that is lining up. All right, almost done. Last step is our miscellaneous expenses, or miscellaneous investment income. And we arrive at the 1168. All right. So when we put this total cost of change together, we should see that each one of these changes, plus our initial starting line, our initial starting net income, add up add up to the net income in this previous year. All right. We could just put in an automatic if test, right? See whether or not our bottom line. I guess a better way to phrase it. I just broke something. Oh no, I'm matching the wrong item. There we go. All right. So if we start from our net income from the previous year, add in all of our changes to the bottom line, it should add up to the net income that we initially observed in the income statement. All right. So again, like we talked about in the example with Amazon, what are the largest changes that we're seeing between 2022 and 2023? All right, both positive and negative. All right, well, let's start one step further back. Did the net income increase or decrease over the year? Right, 2022 we had net income of 13,600. 2023 11,680. So did the net income increase or decrease? Yeah, it decreased. All right, so we should expect that overall the changes result in a negative value. All right, so what were the changes that occurred that had the largest effect on the bottom line? Right, that's why we have the percent change here to guide us to what were the largest changes. All right, so what was the largest change that had a negative effect on our net income? Exactly. Yeah. Right. Had an almost 30% decrease effect on our net income. Right. So almost 30% of our change is resulting from the increase in the cost of goods sold. All right. What's the second largest effect on the bottom line? Change in debt. Exactly. But it had a positive effect. Right. Almost a 21% increase on the bottom line. Right. And from there, the effects were slightly smaller, right? There was a change in taxes. The company had much higher tax rate in this current year. For that, change in miscellaneous expenses were significantly reduced. Revenues increased. Change in investment income increased a little bit. Oh, and I missed selling general administrative. All right, so the entire point of this cost of change analysis is to pinpoint exactly what changes had an effect on the bottom line. All right, and so now we could look at this and see what exactly those changes incurred. Right, so our costs increase, or both cost of goods sold and selling general administrative, right, totaling an almost 40% reduction in the bottom line of this year. Right, so likely management are looking at that and thinking, how can we manage our costs a little bit more efficiently to produce a similar or increased amount of revenue, which would result in, everything else equal, higher net income. All right, any questions? So this is something that you're going to be working on. So I know you haven't been too responsive. Is that because you don't understand or because you just don't want to talk in front of the class? Because this is very important stuff to consider. It's going to be something that you're going to be turning in this weekend for your project. So if you have any questions, I'm here to try to help you understand better. Okay. All right. Yeah, and if you guys want to stick around after class, I can look at your company to help you figure that out. I saw a hand come up in the back here. Okay. Gotcha. Yeah. So that's kind of the thing, is just generally understanding the sort of information that you're looking at, right? So like with Amazon is a really good example with operating expenses, right? Because this company, yeah, there we go. This company broke apart a lot of the expenses. And so it might be difficult to understand what might go under cost of goods sold, what's more appropriate for selling, general, administrative. Arguably, the more important thing is that you're just accounting for all of the expenses. So, right, I would personally argue that cost of sales and fulfillment are cost of goods sold, right? And the remainder of the sales, or the remainder of expenses, would be selling, general, and administrative. Because they're not necessarily directly tied to producing those revenues, right? But some can make an argument that that's not the case, right? Other than general and administrative, marketing, I would hope, also falls under there. But you can make the argument for what you think is appropriate. The important thing is that you are accounting for every single expense. That's the most important thing. It's just kind of another bit of granular information that you appropriately assign those. Any questions, though, on the cause of change? All right. So this is what is going to be due next for your project. Let's see. Yep, cause of change analysis for your company's most recent income statement. So basically, you're going to be going through exactly what we just did. In addition to that, you're going to have a short Word document that's kind of outlining what the main changes were. What are the main changes? What do you think the likely effects are going to be that management are going to have to use this information for, and what changes are likely going to result from that? All right, so please make sure that you go through this workbook if you're not sure. Actually, let me get this posted to D2L before I forget. So yeah, just a little bit more information on it, right? So what exactly were the largest effects on the bottom line? What do you think management will do about it, right? What's the rational thing for them to respond to that change? If it's a good change, great. How can they continue it? If it's a poor change like we just saw with Walmart, what can they do to offset that? And you are going to be working on this further on in your project, but if you look at management discussion and analysis, MD&A in the 10K, likely management will point out the sort of things that you're seeing in the cause of change analysis. Right? If they have a significant increase in costs, that's something that they're likely going to bring up and discuss about. So I highly recommend you read through the management discussion and analysis section, because that's likely going to talk exactly about what you're finding in the cause of change.